We're back with Steve Gibson, and we're here to talk about our client investment portfolios. Hey, Steve, you just sent an email out recently talking about growth and value investing and international. I want to focus a little bit today on growth and value, and specifically why you made the changes more to growth. But first, could you just give a quick explanation of the difference between the growth style of investing and the value style?
Right. Well, at the heart of that is price. Value investors do not want to pay up. Even if the company is growing, they're really looking for bargains. And so they look for things like sustained income and efficiency and margins. Whereas growth investors feel like it's worth it. Give me growing earnings, give me growing revenue, and I'll pay a higher multiple and a higher price, and maybe even take a little more risk because it's worth it. So the growers are obviously often technology stocks or fast-growing consumer stocks, whereas the value stocks tend to be financials and banks and industrials.
So in your email, you suggested that our firm take a bigger allocation towards growth stocks. What's the rationale for that?
Right. Well, I do think that the move into technology is a secular trend, that there may be times when value has its day. But the U.S. economy is, even the markets themselves are at least 50% driven by technology and communication services. We are a technology-driven home services, artificial intelligence, self-driving cars kind of economy. And therefore, I think on a sustained basis, it's going to be the case that we see more returns from the growth side of the shop. Now, you still want to have some value, and that's because that balance gets strained. There is a limit to how much we want to pay for a growth stock. Multiples can get too high. And right now, of course, during the pandemic, airlines and energy companies and retailers, there are a lot of value stocks right now, and the old consumer names as well that are beaten up. They're going to recover some when we get a vaccine and when we get a more normal economy. So we want to not try to time that, so we do want to have some.
So if you want to go more towards growth stock, what type of mutual fund or what type of products are you considering to be buying for our clients?
Well, I think we have an opportunity. We recommended the Qs and have placed those in client portfolios. The Qs are a wonderful 1-2 punch. They do happen to contain these dominant, fast-growing companies that are just household names. They have Facebook, they have Alphabet, they have Microsoft, Google, but they also are the largest 100 companies in the NASDAQ. And in a strained time like a pandemic, you want to own high-quality, large companies because they don't have to worry about financing. It's the smaller companies you have to really be selective with because you have to make sure they can get the capital they need when banks maybe pull back on lending or the bond markets adjust. So that's why you want to get bigger and growthier in this kind of environment.
And what about our small cap or mid cap value stocks? What do you see going on with those relative to the next 6, 12, 18 months?
Well, one of the things we've done is really look underneath exactly what we hold inside of these products. We have several mutual funds, and if you look at it, that's 2,000 different holdings. And so we understand the total picture of what we own. And when we look at that, really, one is we want the best active managers on that value side, and especially in small growth. On the small side, we're going to emphasize growth. We have Alger that's been a star there and done a great job for us there. I think you have to really watch manager selection that understand what kind of small companies you want to own. And so I'm very pleased, and that's probably something we'll hang on to. They've done a great job there. And again, mid-cap over time has been a great place to be. So we don't want to pull back from that too much because any normalization in the economy, those will do fine. But we have to be exposed to large growth leaders because they have reliable earnings.
And I think what you had said was at the end of the day, you would prefer to have about 70% of the money in growth and about 30% in value. Why do we leave that 30% in value?
Well, I think right now it's very particularly clear. If we get a vaccine or even good therapeutics or we develop herd immunity or any of that, the market is already looking to 2021 and 2022. As soon as the market is convinced that we'll get the theme parks open and we'll go back to restaurants, those are still at really reduced prices. So we'll see some action on the value side. And we don't try to time that. So we want to have participation in that when that move occurs.
Okay, so hopefully now you've got a little better understanding of why we're considering making a shift away from value more towards growth. Feel free to talk with your investment advisor, your financial planner, if you have any specific questions about your portfolio or any of the moves that we're making. For now, Pete Hoover, we're signing off.